All right. Hello, everybody. Looks like we're at noon and we want to respect everybody's time. So we are going to get started here. We are here today to talk about energy tax credits. And the reason we think this is important right now specifically to cover is, this new legislation for these credits came out kind of later in 2022. So for all intents and purposes, still quite new legislation. And so we started hearing a little bit more from our clients that, hey, I've heard about these energy credits. How can they help us? Are we really missing out if we don't consider this? And so we really wanted to get some experts in front of them to say, what's in this for our not-for-profit clients. And the reason this is extra exciting, I think, is that often either our not-for-profit clients don't qualify for credits when they come out from the IRS, or you have to get some really complicated structures behind them in order to benefit, something like a new market tax credit or a low-income housing credit, things like that. So this one's quite different from that, in that you don't have to have a tax liability to claim it, which I think is a big deal. And also it's a little simpler in the structure standpoint. But we're going to take some time today to really dig into what this looks like, and how you can benefit from these. So presenters that we have today, I am our director here in not-for-profit tax, so I lead our tax services here for the firm. And with us today, we have David Shereda, who is the managing director of energy services at Tri-Merit. And then also Lauren Groff, who is our service line leader for not-for-profit audit. And she will talk a little bit toward the end about what this might look like for your financial statement audit. Next slide is just the disclaimer. I won't talk about that. We need to have it in here, of course. And then I just wanted to give a really high-level intro. If you are on this call and don't know who Sikich is, I want to give you just a little bit of an introduction to Sikich. So we are a national firm in growth mode, and we have just over 1,900 employees now, kind of spread across the country, including globally in India. And we do have a variety of services we offer here. Obviously, a lot of you likely are familiar with our traditional audit and tax services that we provide. We also do have a large technology practice, cybersecurity, managed services, that type of thing. Also in advisory, we do have some HR consulting type services that we offer. So that's just an example of what's on the slide. And the not-for-profit service line really is a focus of our firm. So we work a lot in several different types of nonprofits. So higher ed, social service agencies, and national associations would be an example, but there's a list here on the slide for you. And then next, who is Tri-Merit, right? So Tri-Merit is a trusted partner of Sikich. We have had a relationship with them for a very long time, working in various types of credits and other tax advantages. And so they were established in 2007. What really makes them interesting and really helpful to us is that they are comprised of engineers, CPAs, and attorneys. And so what that allows them to do is really be technical experts. They have industry knowledge to back that up, and we know that they have the integrity to do the right thing. And they really see themselves as an educator for the marketplace, which is exactly why they're here with us today. So just some quick agenda items. Today, we're first of all to cover, this is CPE eligible. So there will be 3 polling questions that will pop up as we go through the presentation, and then a survey at the end. So again, just a reminder to answer those polling questions. So what we're going to cover today, an overview of the Inflation Reduction Act that created this credit, funding opportunities, resources, talking about the actual credits themselves and the various types, and then how do we monetize this? How do we get the revenue from this? And then I think really importantly, some planning strategies as to what organizations really should be looking at. And then our learning objectives basically just kind of expands on the agenda. So we want you to understand the benefits, understand the eligibility requirements, and then kind of how to get started with this. And then also thinking about an audit and what you need to prepare on your side to be ready for an audit. So now I'm going to turn it over to our expert, David.
Excellent, Jill. Thank you very much. Appreciate the intro. Thanks for covering Tri-Merit at a glance. You hit us spot on what we like to do for the organization and to ensure things are done the right way. It's good for everybody if the industry is knowledgeable, or folks that are taking advantage of these incentives are knowledgeable of the incentive, and that folks are doing things the right way. It's good for everyone if we're all following the rules. So appreciate the time and appreciate the team at Sikich, all great folks that to work with. So get into our stuff. So Inflation Reduction Act. So this is, I guess I should start with, I believe these slides will be made available for folks. As you can see in this one, like I've embedded some links that'll take you to either some of the home of where some of more detailed information may reside. Um, if you're really interested in a nice, long, boring read, you can follow this link. It's about a 200-page guidebook about the Inflation Reduction Act. But it's an incredibly large act, monumental in terms of size and scope. Um, and we'll get into a little bit of the details. I'm really probably going to skim the surface, but this link would take you to one of the original publications of kind of the guidebook for the IRA, and it goes through hundreds of different incentives that were included in this bill. So what you have on this slide, there's the top line estimates are what we would call pay-go provisions. So this is when the bill came to the floor for evaluation. It is an evaluation of revenue generation versus total cost, and the IRA, or Inflation Reduction Act, was introduced as a revenue generator. It was passed in 2022, in August of 22. The big focus was on reducing carbon emissions. So a focus on energy efficiency, a focus on technology that supports clean or renewable energy. And one of the most significant legislations in terms of size and scope related to carbon reduction in energy. Um, so deficit reduction, there's my dot, dot, dot there, which is, it leads me to the bottom corner. Soon after the IRA was passed, you saw like Credit Suisse and Goldman Sachs were chiming in on what was the total investment forecast of $433 billion. And, and as time went by, as the bill was passed and understood, the forecast started to come out that said that 400 billion is probably more like $1 trillion, or 1.2 trillion was Goldman Sachs opinion in March of 2023. And honestly, we stopped really throwing those stats up after March of 23 because they were just all over the board. But the consensus was this was going to be maybe not the revenue generator, but really focus on around $100 billion a year in investment for the Inflation Reduction Act, which generally has about a 10-year runway. Um, but a lot of focus on clean energy, and we'll dig into that. But this was the original estimates on why this bill was valued to bring to the table and to pass. So uh, I won't again go into a ton of detail on the energy side, but this one's kind of an important one to hit on, as why the projections and why this is not only needed, but what are we looking at, right? And another funny thing here for your government agencies, these two slides, I know they're a little dated. They reference a 2022 baseline, but the annual energy outlook from our Energy Information Administration comes out about every 3 years. So what you're seeing here on the slide is without the Inflation Reduction Act, that first slide says no IRA. It is indicating what usage or energy demand by major sector or by major category. So solar, wind, natural gas, coal, nuclear, and other. There's hundreds of items included in other. That's the petroleum, hydroelectric, geothermal, etc. But what's important to point out in this is the first 25 years of this slide. So from 2005 to current, the forecast was pretty nominal demand adjustments, right? Very consistent, hovering pretty consistent annual energy demand. And then in early 2022, which was the driver for the bill, is where you're seeing this huge ramp in demand, which is highlighted by the solar wedge on the top, but essentially it's showing nearly a 30% increase over the next 25 years. And a lot of that is what you would see from data centers and other AI or tech heavy electrification, things of that nature that are going to drive the demand on um, energy. So without the IRA, the other thing to highlight in there is you see the natural gas relatively consistent and generally just a reduction in coal, and then that demand being picked up by a little bit of solar and wind. And the slide on the right is indicating what we would like the future of energy usage to come from. Where would you like the sources? A further reduction in natural gas and a displacement of wind, solar, or other renewable technologies to make up, 50-60% of the demand, as opposed to the 15 to 20% that it would look like without the IRA. So this was the driver for the Inflation Reduction Act, to really try and to get at renewable technology and increase the efficiency and adoption of clean energy generation, and to meet the increasing demand. I know this is a crazy eye chart, right? A lot on this, and that's for a purpose. That these are all of the different energy and climate provisions that were in the IRA, which is a lot. And we're going to touch on a lot of the stuff I've got boxed there. But you can see the scope of what this was that made up this $1 trillion worth of investment. And there's actually another page of this that I cut off because it was less relevant, but a ton of things here that are going to focus on your investments and clean energy financing. And then on the other side is a lot of credits and incentives for the generation of electricity or energy, and things with clean vehicle tax credits, which we're not going to go into detail on. But you can see the breadth of, or the scope of the IRA was pretty substantial. So again, a lot of information here. We'll hit on some of the key points, but I just want to show this for just for size and scope. And it looks like I'm going to take a quick breather, and we've got a first of three polling questions there we go.
All right.
Polling
question number 1. What is your organization's current status with renewable energy projects? We have started credit projects. We are planning to in the future. Currently looking for more information, and uncertain. So if you can take a minute to answer that question for CPE credit. Keep it open.
Looks like we're in the mid 80s for voted, and it looks like we're closed, with the dominant being uncertain in terms of organizational's current stance on renewable energy. So, well, good. Hopefully we'll gather some more intel from this discussion that maybe can help you with moving on in the certainty of investments in renewable tech. So thanks for that. So I'm going to shift a little bit and talk about funding or other opportunities where grant or funding options may come from. And what I'll say is the Inflation Reduction Act started in late 22 and really kind of kicked in gear in 2023. A lot of these funding opportunities, maybe some people have been familiar with. I'm going to throw some stats out there of actual funding that has been issued by either the Department of Energy or other organizations. But also embedded in here are some links that can help you maybe get to the root of some of these. If the Loan Program Office is something you want to explore further, you can follow some of the links I put on there to dig a little deeper. Because again, we're going to hit at a pretty high level of where some of these opportunities came from. But so similar time, so the Department of Energy created has the Loan Program Office. It is looking to fund high impact project, energy related ventures, things of that nature, where private lenders can't or will not provide. So either for whatever reason, it's not appealing to the private sector. The Loan Program Office is there in place to step in and look to provide funding options for folks that are going to deploy large commercial or large scale energy projects. Generally, you're going to see they're focused on energy generation. Obviously, the DOE and this office is more focused on the generation versus some other technologies that may be tech neutral. But again, energy generation and clean energy projects. And in the last 2 years, since the IRA came on and the Loan Program Office funding was there, they've financed, this is from their site, almost $44 billion of clean energy projects across the United States, which is substantial in a 2-year period, knowing that this isn't always a full financed project from the Loan Program Office, but it's covering a good portion of their investment, which would indicate that they've reached out to a lot of areas to expand the use of clean energy projects across the U.S. This is maybe a duplicate here, the Inflation Reduction Act guidebook. So that I had the first slide up there in the same link, but as I showed in the previous slide before the question, there are hundreds of programs out there. The Inflation Reduction Act guidebook is long, but it does have like 1-page summaries on over 100 assistance programs, some of which have expired at this point and others which are still active, which we'll touch on here in a minute too. But another good resource is to look at the original the guidebook with all the assistance programs mapped out in there. Additional DOE opportunities. So the DOE it took on a ton of different avenues to drive the adoption of energy, clean energy investment. And so the clean energy infrastructure programs at the DOE take a couple of different shapes. But this Office for Infrastructure was established in 2022. So around the timing of the Inflation Reduction Act, it was recognized that facilitating infrastructure improvements in the clean energy world and helping to go after climate change, which is their directive, it was a gap. And so the Office of Infrastructure was established through the DOE. On their homepage and through their site, you can see a lot of their fundings, either the existing programs or new fundings that come up. There's a few links to those. But also they have a connection to the bipartisan infrastructure law. So this is a different program, but the IRA and the bipartisan infrastructure law, or the bill, they named the bill, they overlap a bit, and the infrastructure program office brought a lot of that together on their site, where you can see the list of opportunities that would be present through the DOE through either one of these programs. They'll show some, full disclosure, some of what they show has expired. So please be aware when you're looking into these programs, they may have had applications or timing that has lapsed, and they're usually sorted top to bottom with relevant projects and programs that are open on the top. But please be aware of that if you're checking into these things. But the DOE has many different sites, and you can find a lot of them through this infrastructure homepage. Some other funding opportunities. So this first one is it's a really cool tool, but it's a database of state incentives, specifically renewable and energy efficient programs that are out there. It is not DOE funded. It's actually compiled and facilitated by North Carolina State. It's a great site. It is an interactive map, and you can click on each state, and it would direct you to what is available state by state, policies, tax credit, grants, lots of information, but it will give you an understanding of what may be available locally for you. Very cool site to have in your back pocket if you are looking at investing infrastructure improvements, and through that process want to see if there's any opportunities for funding or credits that are at a state level, in addition to some of the federal stuff that we're going to discuss. Another opportunity, so this is through the EPA, a greenhouse gas reduction fund. So this is again going to be specific, or as it sounds, specific to greenhouse gas reduction. They're looking to do low emission technologies. It's a grant program, competitive, so there's applications. It's overseen by the EPA. It's for a variety of entity types, but this is one of the others that gets narrow focused, where the DOE was looking at energy generation primarily. You see this group through the EPA looking at environmental zero emission technologies. And similarly, the Department of Agriculture has some grants, has some loans, some other options available, focusing on kind of a broader range of not only renewable energy generation, but other items that have zero emission systems that aren't generally or not just necessarily generating energy for the grid or to support the demand on the grid, but they have a ton of of financing opportunities through the Department of Agriculture. Now they are limited, so this isn't a full funding options, but they were allocated roughly around $10 billion in loans, and it isn't to cover full cost. It is some of their programs for financing are capped at 25%, and they do have some other focused on rural areas and REAP grants. And those have different limitations, whether it covers 50% of total cost or some portion through loans that are just made available for targeted areas, for rural community, energy efficient, electrification, or battery technology. So a lot of interesting programs there through other the non-DOE organizations. A few more. So the manufacturing energy supply chain is another office. This is a DOE office, but this one, so apologize jumping in and out of DOE, but this one has a totally different focus where it really is on supply chain and the manufacturing of renewable energy technology. So this office is going to have different funding opportunities and different ways to potentially seek even financing, but it's going to be focused on building manufacturing base of this renewable tech supply chains in this country. And you'll see that we're going to talk about a federal credit that's aligned with this, but these are some other opportunities that aren't necessarily the federal credits. These are different ways for fundings to look at for the manufacturers. I included the link again here to their website and directly to their funding page, and that's a snapshot of what the funding options look like in general. But you can see there were 25 total. I only snapped the first couple. Again, the caveat here is keep an eye out for either the due dates for applications or the applicable dates for the incentives, because some of them have lapsed, some of them have been extended. They do update these sites pretty regularly when changes to their programs come about. Again, so state and community energy programs, similar story here, but this is state and local organizations. This is run by the Department of Energy. The other program we had talked about from the North Carolina state was not tied directly and was a little more broad and interactive, where this is going to be focused on the Department of Energy specific or funded programs at state and local levels. Unfortunately, so this Renew America for nonprofit was a great program. Some of the last of those programs wrapped up a couple of months ago, so I'm not gonna spend a ton of time except highlighting what came out of these programs in 2023 through these programs, state and local. $45 million were to support energy improvements, and then their campaign switched a little bit in 2024. They had a Renew America's nonprofit program, and that kicked off early in 24 and ended a little bit ago, but it was focused on reducing carbon emissions for 501c3 entities, and they had a $50 million worth of incentives that were on the table. And again, some of these are closed, but I included the link anyway because they do update regularly, and if new opportunities come about, there's sites to have handy that are nice to have. This one, in full disclosure, stole from a DOE webinar slide. I just like that it kind of summarized what we've just talked about for the last 10 or 15 minutes, that support can come in a variety of forms, from grants to funds to rebates, tax credits, which we're going to get into, but it comes from a wide range of areas. So keep the lookout, ask the questions, reach for help to see if there are other opportunities out there if you're looking to invest in renewable tech. All right, so we're going to switch gears a little bit and talk about some of the renewable energy credits. We're going to focus on what I call ITCs and PTCs, and I'll apologize if I keep getting in and out of the acronyms, but it's just common talk for us on the type of projects we're talking about. So The main ones are investment tax credits, ITCs, and production tax credit, PTCs. The big difference is really in the name of how you benefit from these incentives. Investment tax credits are going to focus on a one-time credit based on the investment into renewable property or renewable technology. That's investing in solar panels, geothermal, things of that nature. One-time credit after you place the asset in service. That's how you can get the credit. Alternatively, the production tax credit comes in two fashions. One's around energy production. So that's similar to where you're investing in renewable energy systems that generate electricity, but you're going to benefit from this annually for a 10-year period based on the energy produced and sold to a third party. So I won't cover a ton on PTCs as we go on, but think of these as large scale systems. So you would be putting in large solar fields or wind farms in order to capitalize on the PTC. Alternatively, those same investments would generally pursue ITCs if they are smaller in size. And it's a one or the other for the investment. You can't, or for the asset, you can't do both. The other piece of production tax credits is around the domestic supply chain. So this is in line with some of those manufacturing grants and incentives we talked about, but this is for the manufacturers of components or goods that go into solar, wind, or battery, or are into critical materials that are used in those technologies. So there's a list of 50 materials that I'll pop up in a couple slides that you're going to see what we're talking about. But if you're in the manufacturing of or refining, recycling of critical materials, there's a credit that has, again, a 10-year runway where you can earn the credit based on the actual components produced and sold. And those credits come in forms of like an amount per piece or an amount per kilogram or things of that nature. But it's for something you produced and sold. So again, different from an investment where you are producing a good and taking to market. Oops, sorry, got off the buttons here. So let's talk about the values of these credits. What are they worth? How do you get after them? The investment tax credits, often called IRA credits, often called Section 48, maybe Section 48 Cap E. There's different ways we call the same thing based on either the code or just people's understanding of what the credit is. But it is, again, an energy property investment. You made an investment in technology that's approved, which I'll show on the next slide. But the base credit starts out at 6 or 3% of your qualified basis or your cost. So the delta between 6 or 30 comes from the three items I listed there. Either you are compliant with prevailing wage in apprenticeship with the construction of your asset, or your construction started before January 29th of 2023, which has to do with the introduction of these rules and regulations. So it's not an arbitrary date per se, but if you started construction before that date, you would qualify for that 30%. Or if your system is less than 1 megawatt in output or thermal equivalent. So most projects, if you're talking rooftop solar, if you're talking geothermal for your commercial building or your office building or your school or whichever it is, are going to be systems that are less than 1 megawatt in output. And you would start off as a base credit of 30% of your qualified cost. That also applies to bonuses. So for investment tax credits, there are three different types of bonus: for domestic content, energy community, and low income community. I'll explain those a little bit more detail again in a minute, but the point here is the bonus is 2 or 10%, again, based on those three criteria we just discussed. So if you are a system less than 1 megawatt, you have start with a 30% base, and any additional bonus just adds to that. Another 10% for domestic content, another 10% for energy community. So you could get up to a 30, 40, even 50% of your cost could be actually up to 70 at the max of your cost could come back to you in investment tax credit. Pretty sweet deal there. So what's qualified? These are the qualified technologies. It's the first three or four on there are what you generally think of for renewable tech, or most people think of when renewable technology: wind, solar panels, geothermal, energy storage. That's batteries. It could be thermal energy storage or energy storage for like batteries. The others get a little more unique, and you see them in larger scales: biogas, microturbines, fuel cell technology. Combined heat and power is popular for larger organizations. We have a couple examples we'll share later in this deck about CHP systems. But that's the technology for ITCs. And those last three, the CHP, combined heat and power, microgrid, or electrochromic glass, I list them as expiring in 2024, which means there's a change in incentive where we shift from the ITCs that are open to all these technologies, and come 2025, we're looking at more negative emission or emission neutral technologies. And combined heat and power, microgrids, and electrochromic glass are on the outside of that come 2025. So the ability to qualify for those incentives going forward is if you started construction in the year of 2024, then you can qualify for them. But after 2025, those technologies are not included in the ITC. So I mentioned prevailing wage and apprenticeship, and I glazed over it. It was worth a slide because it's a pretty big factor if you're viewing larger systems that aren't going to qualify for the max base credit based on their system size. So prevailing wage and apprenticeship, or PWA, is two parts. One is the prevailing wage. This is often called Davis-Bacon Act rules. This is a wage and fringe that you pay to the laborers. So this is for manual labor in the construction of your asset. So these are the folks that are building your solar system, installing your wind turbines. They have to be paid at a rate that is established by the Department of Labor and meeting the wage and fringe amount. So many of you may be accustomed to Davis-Bacon Act or certified payroll on jobs that are for public buildings, courthouses, schools. A lot of times those are built right into the contracts, that's a requirement. So this is the very same requirement as those. It just has the addition of the apprenticeship rules. So the apprenticeship is in line with the same group of people. These are for the laborers that are working on the construction of the assets. And it does have a requirement that there's at least 4 more laborers employed by that company to be counted as apprenticeship. So if it's a smaller project that may have smaller contractors or subcontractors working, it's going to target ones that have 4 or more laborers employed. And then it becomes a percentage of their hours relative to the journeymen that are working on the project. So it's a varying scale. It caps out at 15% of the hours must be performed by apprentices, but it's between 10 and 15% based on when you started construction. If you're starting construction now, that number is 15%, basically going forward through the rest of the IRA incentives. And the other reason was important to point this out, that the penalty for not doing this, but saying you do it, is more substantial than your credit that you would be getting. So if you are pursuing prevailing wage and apprenticeship, we don't take it lightly. You need to document, you need to treat this seriously to make sure that it's adhered to if you're counting on it for your credit, because it carries a lot of weight. There are exceptions for the apprenticeship program if they are not available, but they must be documented, and there's a procedure to follow if you attempted to get apprentices but they were not available to you. So I'm going to jump into the bonuses now. So we talked about the 3 bonuses, the first being domestic content. This is what it sounds like. It's to incentivize the use of domestic products, domestic steel, and manufactured components. The requirement to get that bonus for your ITC is that 100% of your iron or structural steel components are needed to be domestically sourced steel. And so this isn't all steel for the project, but it gets into structural components like rebar if you have foundations under your systems, the tower structure for the windmill in a wind turbine technology, racking for solar panels. But that's a 100% rule for those type of components. The next part of it is anything that's manufactured. So this could be the solar panel itself. This could be the battery itself. Those manufactured products have to be at least 40% sourced by domestic material. Um, in that 40% does go up every year from 2024 up to 27, and then it maxes out at 55% by 2027. So recommendation here is to get involved or get help or seek assurances for domestic content at the onset of your project. Retroactively trying to prove domestic content was made after the investment took place, after the contracts are closed, is incredibly difficult. And if your contractor and or their suppliers weren't in line with the requirements, you want to know that on the front end and not count on that bonus, or you want to count on it and demonstrate compliance on the front end. That's when it's definitely hard to go retroactive and prove that you were compliant to something. Perfect. Another polling question, number 2. If we could launch that one, I will take another breath.
All right. Very important question here. What's your favorite holiday sweet treat out of the list below? Fudge and all things chocolate, sugar cookies, well, all cookies, all things candy. I'm not much of a sweets connoisseur. Give you a couple more seconds to answer this. We probably don't need to review the results of this one. So
I find that pretty hard to believe that you're not a sweets connoisseur, Joe, but maybe.
That is definitely not me answering that.
All right. Very good. Well, we'll continue. Thank you for participating with that. It is the season for those type of questions, right? So renewable energy investments, the other bonuses. So we talked about domestic content. This is energy community. So I took a snapshot of what the map looks like. It's an interactive map. This is sponsored by the Department of Energy. I did include the link on this page if you wanted to dig in to see if you're in it. But there are 3 different ways to qualify for energy community, but it earns you that same additional credit bonus. It's again looking to drive investment to these areas. And the 3 main areas are either a brownfield site. So this is something where there is environmental impacts to the land. So this is officially designated brownfields, not just assumed, right? There is defined categories for brownfields. This is one, if you think you're in these areas, it needs to engage folks to understand that you've got to demonstrate that you are an official brownfield. So it may take a little bit of effort, but it's a great kicker to a bonus, or a great bonus to a investment if you are in these programs. The other 2 are definitely more, they're all geographical, but the other 2 are a little more straightforward to determine, whether you're in a metropolitan statistical area that also includes unemployment in the area that is at or below the national average. So these MSA areas are tied to the revenue in your area has some connection to the fossil fuel industry. So what they're trying to do is say, let's invest renewable tech in the areas that there is revenue generated from fossil fuel industry, whether that is through the manufacturing of or other means in those areas. So it's trying to direct revenue there or investment into those communities. The other is coal closure areas. So these are census tract areas based on 2000 and 2010, where either coal mines were curtailed or they were coal-fired electrical units. So if you remember on that one early slide that we had the images of the energy growth, and you saw coal really shrinking down, that has been in place to reduce the dependency on coal for 25 years or more at this point. But those areas that had coal mines or coal-fired electrical units were retired, they're looking to either reinvigorate or drive more investment to those areas based on this bonus. So the map's really easy to use. It is not the official support that you need to claim the credit, but it is a very good indicator of if you are or are not in those communities. Similarly, we have the low income community. This one's a little tricky, but it does have an interactive map to determine the first step, which is, are you in a low income community? And the reason why this is a bonus is the same as the last. We want to drive, or the DOE is targeting to drive investment into areas that are impoverished or persistent poverty or low income communities in the country. This one does have an online application facilitated by the Department of Energy. You have to get an award, so you have to go in and apply with what you intend to do. So what you focus on doing, it's going to be focused on solar and wind technology. So it's energy generation in these communities, and you have to apply for what you intend to do. So the size of your system, DOE has a process to evaluate where they allocate the bonus to. That all has to be done before the asset goes in service. And it's a bit of a process. There are some, if you follow the link to this map, you can also get back to the home page for low income community, which will show you, there's presentations that walk you through the process and some instruction sheets, but it is a service that we assist folks with. But if you wanted to check it out, follow those links and you can see what this process is about. There are four main categories where they allocate benefit to, the DOE does, and it's either if you are in a low income community, if you're on Indian land, this is where the asset is going to be located. The next two are either qualified low income residential or qualified low income residential with an economic benefit. So the caveat to those bonuses was that program for the economic benefit category with low income residential investment can be up to a 20% bonus. So that if you are, it's worth the check on the map to see if that's even on the table. If you're making an investment into solar or wind, it's worth the effort. The 1.8 gigawatts of capacity, that's how they allocate it. It's not based on cost, it's based on energy you generate. So they have a budget, for lack of better terms, of 1.8 gigawatts of capacity that they slice and dice through those four categories and allocate it based on applications. I'm going to shift gears a little bit on PTCs, and this was the other one that you benefit a credit from energy production annually. And so the value of these, it seems small at half of a cent up to 2.75 cents per kilowatt hour. But again, these are done at scale. So if you're doing large scale systems, that's a relatively respectable bonus that or incentive that's worth pursuing when you're building energy production at scale. The delta between the low end bonus to the high end bonus is the same rules that we discussed for ITC. So there are three conditions to get the max. You have to meet one of the three. So the other part of production tax credit we talked about was domestic supply chain. That's code section 45X. It's eligible components. There is no prevailing wage requirements for 45X. It's just specifically about the product you produce. If it's qualified component or eligible component, you can earn that after you've produced and sold it. And this is for the manufacturer of these components. So if you're making products for the renewable energy industry, it's worth a look to see if 45X is available to you. And I'll pop up the technologies in a second. Bonuses, these are the same bonuses we talked about in ITC, except there's no low energy community or low income community, sorry. Domestic content and energy community bonus still apply. The bonuses for a production tax credit is 10% of the credit. So whatever your credit is, dollar amount, you can get a 10% credit boost. So the difference was in an ITC, it's 10% points or 10 additional percentage of your cost. This just becomes a 10% bonus of your credit. Okay, so technologies you'll see which are applicable to PTCs, very similar technology, but again, these are done at scale, so it's bigger stuff, large wind, hydropower, other technologies that you would see done at large scale. The 45X is the other box, which covers the technologies in solar, wind, battery, or critical materials. The critical material list is over 50 different materials. That's just a snapshot of the materials. But if you are in the industry of supporting any of these industry, or in the manufacturing business of supporting these industries or these critical materials, worth a look at 45X. Great opportunity. So looking at what's ahead. So I touched on this briefly on January 2025, the shift toward technology neutral credits. So the existing regulations under Section 48, which are the ITCs, is replaced by 48E, CAPI. Similarly, the 45 regulations for production tax credits is replaced with 45Y. So the short history of this is the original investment tax credits have been around since the 80s, and they've had different levels of value. And the IRA really kind of boosted their value in 2022 and brought them back up into the spotlight. Well, they were a little dated, so the Section 48E and Section 45Y were introduced to take place in 2025. Now, those regulations are going to focus on tech neutral. You'll see on that chart, they start to phase out in 2033. So they still have a nice long runway until through 2032, and then they start to back off in terms of phase out of opportunity for those incentives. And this is again more specific on which ones are in and out. I think I already covered most of this probably in advance on those others, but the focus going forward for the IRA incentives are on greenhouse gas emissions or GHG emissions at 0 or less. So this is solar, wind, hydropower. Inherently, those do not generate emissions. They are using thermal energy, they're using wind energy, hydropower, of course, and there's a list of others that are included. So those ones we talked about, combined heat and power, those will be off the table in 2025. And in some cases, combined heat and power is still available for 45Y. It just has some stipulations on the amount of emissions. And I'm going to pick up the pace a little and talk about the fun stuff. So how do we monetize? Where do we get the money for these incentives? So there are 3 ways that you can monetize credits. One is the standard method of using the credit, offset of tax liability. Second is elective pay or direct pay available for nonprofit organizations. And the third is transfer or sell these credits to the open market. We'll focus primarily on the direct pay, but just to hit, using a credit is this typical method to use a credit. It's a general business credit. You can carry it forward for 22 years. You can carry it back for 3 years. And this is typical for many different types of credits for industries that are, or for for-profit entities. The IRA incentives very much in line with those. Direct pay. So the direct pay or elective pay process is new in 2023, part of the Inflation Reduction Act, that allows tax exempt entities, state and local governments, to benefit from tax credits, right? So this is tax exempt entities' ability to benefit from tax credits via a refundable tax credit. And I'll walk through the process on the next slide a little more detail, but there is a pre-filing registration. There are some limitations to consider around tax exempt bonds, domestic content. If you get larger, you have a requirement for domestic content, not just a bonus, but if you're pursuing elective pay and your system is greater than 1 megawatt, it needs to include domestic content or there may be a reduction. Common projects are rooftop solars, combined heat and power. We've had, and I'll share some of these examples in a few moments, but this is the process of what that looks like. So if you earn a credit, and that's the air quotes of earning a credit, that you've made the investment, you've placed your asset in service, it is functional. Now you got to look at, how do I monetize it if you are a tax exempt entity or nonprofit. there's a process called pre-filing registration. It's a portal, or we call it the portal. It's an online system facilitated by the DOE, and you need a couple pieces. You need an ID and Me account. You need to register your entity as on sam.gov, which is the Department of Labor site. So a couple minor tasks to do, and then you get into the pre-filing registration. It takes some general information about the entity. It's not incredibly challenging process. There is a very long document that can walk you through it, or folks like us help with that process. But it is a pre-filing registration process. The IRS says it could take up to 120 days to process. We've seen that look more like 3 to 4 weeks, but plan ahead when you're doing these investments. You need to get on and do your pre-filing registration in advance of when you are needing to file your tax returns. So the IRS reviews during that 120-day process. The next thing you're doing is the analysis of credit, determining bonus applicability, and finding out where your value is for this credit. You've got to do forms and some statements, or there are some additions to the standard tax forms that need to accompany the tax forms when you file your 990T. The filing of your 990T team at Sikich is generally when we partner with the folks at Sikich, our services kind of end at the preparations, and we hand it over to Sikich to take it the rest of the way to file those 990Ts. And that's the way the elective pay process is monetized. It represents essentially an overpayment, and the Department of Treasury refunds that amount to the eligible entity as a credit. So your credit looks like an overpayment in tax. That tax gets refunded, and it's facilitated through the 990T. Which this is probably just the same thing I just talked about in 990T filing, but it's a couple points on 990T is they require them to be e-filed, but there were some issues, of course, with the IRS's software and software platforms accepting the 2022 returns or 2023 returns. So late in 24, the IRS did make the option to paper file, but that option will go away once all their software issues are worked out, and the filing will be required to do electronically. So the key here is, even if you don't file annual tax returns, if you've never filed a tax return, the process still follows what we just described, where you still have to file a 990T, even if it is only for the purpose of claiming this investment tax credit through the elective pay process. It is available to most tax exempt entities, 501c3s, 501c fill in the blank. There's forms for the 6417s entities. That's your governmental entities. That's your cities. That's the mechanism that they file under that type. The tax form 3800 along with the 3468 are required for the 990T, which is just the tax forms that all of that data in accounting of the benefit is captured. This kind of takes us to there's some incentives on the IRS site that have some flyers and some good general information. I wanted to include this because I will give credit to the IRS for their documentation that they've put out on this program. It's pretty informative. It covers a lot of the bases, and it's worth a quick reference to the IRS site under irs.gov elective pay. I'm a little short on time, so I'm going to cruise through a couple of these examples. Specifically going to hit on this one. This was in partnership with Sikich. This was one of the clients that we got introduced with them. Large charitable organization in Ohio, 250 kilowatt solar carport. So that's not a large system, but it's a decent sized system in a parking lot, added for solar and obviously cover for vehicles. Total cost in the system was close to $750,000. It was placed in service April 2023. They qualified only for the 30% ITC. The note here was a short turnaround time in the in the project. We kind of got introduced in August, and we wrapped it up by completed and filed it on November 11th. So ideally, we'd like a little bit more time to help navigate these challenges, but we're able to help these guys benefit from this program and end up claiming their $217,000 federal incentive for their investment. This one I will hit on, and then I'll jump over and hand this back to Lauren to wrap. But this is a unique thing in an interesting twist on what's available for tax exempt entities. This was a Lutheran church in Texas, rooftop solar project, placed it in service in April. They're qualified for an energy community, and the ITC and domestic content was reviewed. Unfortunately, does not look like they were eligible. But actually, this wasn't the exact example I want to say, but I'll tie it in here. So these guys were a calendar year end, but if you were a fiscal year tax exempt entity, you have an ability to flex if you've never filed taxes, to flex to a calendar year option. So then you can monetize your credit on a different schedule than your fiscal calendar, which we've taken advantage of for many programs to capitalize on these incentives in a more timely manner. And with that, I need to jump to the final polling question, and we'll start there to wrap. Great, another
Name that movie quote. You did it. Congratulations. World's best coffee. Is that Christmas Vacation, Elf, Jingle All the Way, or The Grinch? And I hate trivia, so if you get it wrong, don't worry.
No wrong answers.
No wrong answers, right? It's just for CPE.
Very good. Well, but we'll see who's up on their holiday trivia. Okay, to wrap these on the last questions, I'm not going to hit on the credit transfer. It's more applicable for tax exempt or not tax exempt entities, and then I will. But the data's in here, and it's an option to monetize through selling credits. And jumping right over to our accounting considerations. Thank you, Lauren, if you would jump in.
Great, thank you, David. Well, with only a few minutes left, I'll just wrap up kind of very, very quickly here. What does the accounting look like? Once you go through this project, you're able to claim your credits, file your 990T. How do we account for that on our nonprofits financial statements? You're going to follow the guidance in ASC 958-605. So for many nonprofits, this is probably very familiar. GAAP codification reference, this is the guidance for recognizing a contribution or a grant or contribution guidance. And so really it's going to come down to nonprofits determining whether or not the tax credit is conditional and when those conditions are met. So primarily qualifying for the tax credit, maintaining all of that documentation, kind of going through that filing process that David went over with us, and filing for that credit. So the key here is that to review each credit and circumstance carefully, analyzing that guidance, and then document the considerations for the timing and recording of the revenue recognition. So this guidance is similar to other guidance we've seen in relation to some of the pandemic relief tax credits that we've seen over the last couple of years as well. And so then go ahead and move to our next slide. So when do I contact Sikich? Contact us early in the process. Our team can assist with questions and guidance as you navigate the process and ensure the proper steps are taken to qualify for the credits and the proper tax filings are completed. I did want to take just a moment to introduce Larry Johnson, who is a senior tax manager with Sikich. Larry's really handling a lot of these tax credit projects in coordination of meetings, consultation, and working with Tri-Merit in our partnership on these tax credits. Thank you, Larry. If you want to say just a few words as we wrap up today.
No, welcome. Yeah, well, thanks for coming today. And we have a very servant approach to helping tax clients. So if they call, or helping potential clients, they call, they want to talk, we'll go take them through the process as best we can. We'll introduce them to Tri-Merit, and we'll work with them along the way. on the registration process, potentially help with the 990T, answer questions, and help navigate these complicated waters. So it's exciting stuff. It's great money out there, great opportunities, and it may be consistent with your organization's goals. So thank you very
Great.
much.
Well, with that, I want to thank you all for attending today and for your time. Thank you very much.